Morning, everybody. It's John and Anand here. As you can see, we announced this morning our intention to divest Medicover Hospitals India. This is a significantly important deal for Medicover, and today we want to share the details of the transaction and be able to take any questions that you have. Here you can see the transaction highlights. Medicover and local partners to dispose of 100% of equity capital. To global investment firm KKR for a purchase price of 105 billion INR, equivalent to 0.95 billion euros. So a strong valuation for us, and we're very happy with that particular position. On top of that, KKR will acquire the loans, the Medicover loans that we have of 0.1. And the accrued interest, and this transaction represents a enterprise value of 1.2 billion, which is by far the biggest transaction that we've done in our history. So it's pretty significant for us. In terms of the proceeds, and how they will be distributed, Medicover was 66.1%, and our minority shareholders are 33.9%. And Medicover will receive cash proceeds of around 0.74 billion, including 0.1 billion from the loans and the accrued interest. A deal certainty was important to us, and this transaction is subject to the usual kind of merger and control approvals, which will take a few weeks or months to be able to conclude. And closing is expected in the fourth quarter. So that gives you the high level picture in terms of this deal. I'll hand over to Anand, and he will talk you through a little bit more detail in terms of the deal and what it means for the group.
Thank you, John. Good morning, everyone. As you say, kind of a momentous day for us at Medicover. In terms of what this transaction does, clearly it gives us immediate value realization versus other options. So obviously we get 100% cash sale, and that kind of gives us a execution certainty element, which is important to us as well. What that certainty does and the amounts we're talking about means that clearly gives us an enhanced financial flexibility in terms of strengthening our balance sheet, which naturally means, as a consequence, we have greater strategic optionality to make decisions in our European markets. But now this is a signing, not a completion call, so our financial targets remain the same for anyone who wants to ask. At completion, we will discuss anything relating to midterm financial targets further. I guess to give you a flavour of our performance, including and excluding our Indian hospitals. So if you look at the table on the right, you can see the pro forma numbers in the first column that we've reported over the last 12 months. Which shows your revenues of 2.46 billion at EBITDA margins of 16.1%. If you take the indicative MHI numbers, so Medicover hospitals in India, in the second column, you can see the revenues and margins relating to that business. And then on the far right, we'll say what are the underlying numbers, I'd say, for Medicover, which remain co, let's say, if you exclude Medicover in India. So you can see as a consequence, you strip out about 220 million euros worth of sales over the last 12 months. But importantly, what you can see by excluding the Indian numbers, which obviously, as you know, we've had a great first 2 quarters this year. Actually, the margin in the business is lower, as we've said before in the past, versus the company average. So the consequence of doing this deal, naturally, our EBITDA margins increased by about 40 basis points, and our EBIT margins increased by about 50 basis points. For those interested in EBITDA, clearly, because we use that a lot, as it's kind of cash profit, as I call it, given the lease profile in India, which is a bit heavier, and clearly leads into the enterprise value that we discussed on the first page, you'd expect another 20-30 basis point improvement versus the EBITDA margin improvements, I'd say. So if EBITDA and EBIT are around 40-50 basis points, then you can expect EBITDA margins to about 80-90 basis points. In terms of what that means for us, including and excluding India, again, in a little bit more detail from a revenue perspective, a geographic mix perspective, and a payer mix perspective. Broadly, I'd say, kind of largely unchanged in terms of the splits. You'd kind of expect to see what you're seeing. So I think if you look at the top row, you can see the numbers that we've reported historically, either over the last 3 years in terms of revenue and margin growth, and the revenue mixes at the end of Q2. And if you look at the bottom row, you can see the numbers excluding Medicover in India. So I guess one thing to note is actually the underlying business, excluding India in hospitals, is pretty strong. So if our CAGR growth on revenues has been 16.3% over the last 3 years, actually excluding India, it's 17.3%. So stronger. In terms of the second column, which is a revenue mix, you can see that, that's just kind of a consequence of splitting out the 10% of revenue sales across the rest of the market. So you can imagine and naturally expect that actually, Poland, Romania, and Germany are kind of soak up the rest in terms of the mix. And finally, in terms of a revenue mix by payer perspective, again, small changes, nothing material. But actually what this demonstrates is, as well as a stronger P&L in terms of a margin perspective versus a kind of a revenue perspective, overall there's a balanced portfolio and more focused Medicover going forward on the back of the hopeful conclusion of this transaction. So with that, I'll hand over back to John.
Okay, so key takeaways. This is an attractive exit for Medicover. We've monetized our investment in India. We went there a decade ago, a really small organization, built it up to be a significant operation that has a good potential for the future. And we feel that this is a good time for our exit, given the dynamics of this deal. A much stronger balance sheet as a consequence of this, so it materially strengthens our position and gives us a lot of choices in terms of our existing markets. We've got good existing markets. We've got strong strategic focus. We talked to you back in February about the opportunities that we have in each of our markets, and this will give us a stronger focus in the markets that we operate in Europe. And we've got more than enough opportunity in terms of opportunities to grow in those particular segments, particularly in our fee-for-service line. So, over time, this gives us an opportunity to accelerate there. And our platform is strong. So you can see that from what Anand's just gone through in terms of this is a good or great deal for Medicover, and that it doesn't significantly impact our shape and our financials in terms of ability to be able to deliver good returns. So we think we're in a good position here. So as you can see on the right-hand side, we still expect the revenue to grow. We still expect our margins to improve. Gives us a lot of flexibility, and of course we will have even better cash conversion. So we think that this puts us in a strong position. So we'll now hand over to the audience to ask us questions that you may have, and we'll look to answer them. Thank you very much.
If you wish to ask a question, please dial pound key 5 on your telephone keypad to enter the queue. If you wish to withdraw your question, please dial pound key 6 on your telephone keypad. The next question comes from Christopher Liljeberg from Carnegie. Please go ahead.
Hi, good morning. Quite a number of questions. I'll start with 3 and then get back to the queue. So first of all, seems like a fantastic deal. Would you be able to provide a figure how much euro you have invested in India so far? That's my first one. And then the financial figures here you provided for India, has the margin profile changed much year to date? Or is it the same type of dilution we could expect as you provided for last 12 months? And then the third question is if you maybe could provide a bridge for taking us from your share of the 1.2 billion enterprise value and the cash proceeds. Thank you.
Yeah, I'll handle that. Hi, it's Alan. Hi, Christopher. So I guess I'll take it in reverse order. So, in terms of the share of 1.2 billion, so 1 billion of that is equity, and then about 100 million is the loans that we've invested from a Medicover group perspective in Medicover, and about 100 million euros, you'll have seen before, India's quite heavy from a lease perspective, yeah. So that totals up to 1.2 billion. In terms of our split, and we've got 66% of the business versus our minority partners. So in terms of the equity, clearly we get 66% of it, which equates to just under 0.7 billion. But obviously we've given the loan, so so that's kind of the 0.1 billion that goes on top, which is a consequence of the deal. We'll get paid at closing of the transaction or a few days afterwards. In terms of the margin profile, I think, look.
So could I ask, will there be any tax impact here? Realization tax?
Yeah, so look, obviously we've got lots of very highly paid advisors that look at these things. We reckon anything from gross to net will be around 1 to 1.5% of the cost of the value of the gross proceeds. Yeah. So if there will be a cost, at the moment we assume it's going to be relatively small, considering the actual transaction size. So yeah. We're talking about 500 million incoming into Medicover, and 1 to 1.5% of that is a relatively small amount as a consequence gross to net. In terms of the margin profile over the last 6 months versus the last 12 months, it's broadly the same in all honesty. So obviously you've seen our our revenues have grown materially in H1 this year. But obviously, as I think we've always said before, you invest in the doctors, then the revenues come, and then ultimately you get margin improvement later down the chain. So I'd say the last 6 months are broadly similar to the 12-month numbers that we've shown. And in terms of what we've invested in India, I mean, look, I'm not going to tell you the exact numbers, but it's a good deal for us. You can work out the EV to EBITDA multiples yourselves. But look, we've invested, as I said, over 100 million of loans in India, which will get paid back at completion. And naturally, there's been maybe about a similar level of equity investment that we've made over time.
Okay, thanks. I'll get back to the queue.
Cheers. Thanks, Chris.
The next question comes from Matthias Vatsten from SEB. Please go ahead.
Hi, good morning. Congrats on this deal. It looks very good. My first question would be if you could resonate a bit around growth opportunities in core markets, Poland, Germany, Romania, and general capital requirements as of now. Should we anticipate the same sort of compounding growth profile of Medicover, or do you see any larger opportunities now that you're almost or nearing up to a net cash position post-deal? Thank you.
Well, I guess in terms of growth of Poland, Romania, and Germany. So look, I think when we did our investor call in February, I think we talked about 4 strong markets and great opportunities across all 4 markets. Now going forward, if this transaction concludes, then clearly we still think there's ample opportunities across 3 of the markets. Now Poland is still obviously 50% of our business, and we've demonstrated and have shown, I hope as well, that as well as kind of historic growth, that we've got further opportunities going forward. So I'd say actually in terms of a risk profile, if anything, it kind of improves it from a company perspective. You take out a tenth of the revenue of a business that's, let's say, below company margins. So that naturally strengthens. But fundamentally, in terms of the countries and that we kind of operate in, if you look at it holistically, then there's further growth there, I believe still. So the splits will be the same. We'll have the same conversations in terms of Poland, being Poland in terms of the kind of engine room, let's call it that, with over 50% of the revenues. And we still believe there's growth there. Romania is still a growth opportunity. And Germany, which we've always said is kind of a big market. But even though there's challenges in that and there's been material reform over the last couple of years, as we all know about, and there'll be further reform. But we still seem to find a way of growing our revenues, our volumes, and our margins in that market.
That makes a lot of sense. And then in terms of, you still guide for margin improvement in the coming years. So if you look on your margin improvement guidance that you gave through 2028 at the capital market update, how much of that was related to recovering margins in India vis-à-vis the other markets? I guess the margin curve will be a bit milder now.
Yeah, I mean, India obviously was a position where we had a lot of capacity, and therefore there was a lot of drag, and as a consequence, we would fully expect that to fill up and have an impact on margins. But we've signed the deal. We'll move towards closure. We'll look at all of our positions and review them. But we've still got from our perspective, we've still got other immature points within the group and within the infrastructure that we've got. And of course, we'll make further investments on top as well. And our aim, of course, is to grow our business, and at the same time as we're doing that, is to move our margins positively as we grow. So, we'll clarify that as time goes by.
Yeah, and I think just to add to that as well, actually, if you think about it, India is 10% of the business, right? Not 50%. So naturally, as you can imagine, as we fill up the revenue and kind of increase capacity utilization for what we're faced, we'd expect those margins to improve. However, it's still only 10% of the business, and if you extrapolate forward 3 years, it would still be relatively small. Hence, you would expect the kind of margin impact of this to be muted overall.
That makes sense. Thank you very much. Then I was wondering if you could give any guidance on what EBITDA, lease-adjusted margins that you have in MHI last per month. Is it similar to the EBIT margin or something like that?
Yeah. So I think, look, what I would say, and I'm not going to give the exact numbers, obviously, but if our margin, and you can figure it out, so you're a smart guy. If our margins improve by about 50 basis points at EBIT and EBITDA levels, we are heavier on leases in India. So you strip out MHI and RemainCo, as I call it, which is Medicover excluding India, you would expect margin improvement of about 80 to 90 basis points.
Okay. Thank you very much.
All right.
The next question comes from Bram Buring from Wood. Please go ahead.
Yes, congratulations. So with regards to the growth opportunities in your remaining core markets or the immature markets in our region, could you give us a feel of how much of this you think could be organic or via acquisition? And on top of that, given the quantum of cash that we're talking about here, will there be discussions about returning any of that cash to shareholders directly? Thanks.
In terms of our future growth, as we've just said, that we feel in the existing markets that we have, or our historic markets where we first started and first developed, that we've got more than enough opportunity for us to grow. We would expect our organic growth to be strong. Obviously, this particular deal gives us many other choices in terms of things that we could or will do. So they will be layered on top over time. Yeah. And in terms of decisions, in terms of how we use the funds, there's no comment on that for us. We've done the deal. We've got to focus on the closing. We'll review exactly where we are with everything. So no comment really.
Okay. Thank you.
The next question comes from Darius Saftoiu from Jefferies. Please go ahead.
Hi, thank you for taking my questions. I appreciate we don't expect a midterm guidance upgrade now, a different story now. But I wanted to ask in terms of how should we think about the previous midterm guidance qualitatively, as in the previous guidance was implying more than 11% organic growth. And excluding India, if you could provide some color on how should we think about Medicover having been growing above this range in the past. So how should we think about this on the midterm excluding India?
Yeah, I mean, you've got the historic positions, so you can see historically, kind of the pattern that we've had. We will, as I just said in the last conversation, we very much focused on getting this deal done, and we need to close. And once we close, we will talk much more about the midterm guidance and if there's any impact. Currently today, if you were to ask us about the guidance, our guidance doesn't change.
Yeah, and I will have a second question, if I may, please. Congrats on the deal in India. I wanted to ask on how are you thinking about the optimal deployment of the proceeds? And I'm not talking about specifics here. I'm talking more about, let's say, how do you think about organic growth, M&A, and maybe potential shareholder returns, and how do you think about the capital allocation overall now that India is possibly divested?
Yeah, I mean, we gave a very comprehensive overview of our business back in February. At that time we talked about 4 key markets, and we went through those 4 key markets. Nothing has changed in terms of our position for what we talked about in February other than India. Our position on India is that we've traded the certainty of value for the future potential that we could have achieved. And why have we done that? We've done that because we think it's a good thing to do. Pragmatically, it just makes sense. And for us, that then gives us lots of choices for the markets we've got back in Europe. So, if you were to go to February and say, what does it look like in February for 3 of our 4 key markets? It looked really good, yeah? If you now roll forward to where we are today, it looks even better. Why? Because we've still got those 3 core markets. We still fundamentally believe we can grow. We still fundamentally believe that, our key revenue driver will be fee for service, but our balance sheet is in a strengthened position. That means that we will, take advantage of other opportunities and stimulate some opportunities. So I think this is a very positive position for Medicover, because it immediately gives us the certainty of the ability to do things versus the longer term potential. So it's good news.
Thank you.
The next question comes from Christopher Liljeberg from Carnegie. Please go ahead.
Yeah, thank you. 3 more questions. Further down in the P&L, so what type of impact will this have on your financial net? Because you have some financial income. Is all of that related to the loans you have to the Indian business? And also the minority line, will that be back to negative after divesting India or more around 0? And the final question is just what will happen with the brand name of Medicover India? Thanks.
Right. Sorry, Christopher, we had a bad line. Can you repeat your first question? I got the second 2. That's fine.
Yeah, the impact on the financial net line. So I guess you have had some financial income from borrowing money to Medicover India.
Yeah. Okay, fine. So look, I'll let John answer the brand question. I'll take the other 2. So in terms of non-controlling interest or minority, you're right. That kind of comes down to pretty much 0. So India's been the majority of that number, but we've still got a small amount of business in Scandinavia. So but it's kind of pretty much near 0 from that perspective. In terms of the P&L impact on the rest of the business, I think naturally there'll be, if the transaction concludes, there'll be a little bit of an impact as a one-off transaction perspective with regards to FX realizations, etc., and things like that of historic positions. But underlying actually the strength of Medicover in the past actually has been, let's say, growing our cash to grow ourselves from an internal perspective. rather than rely on debt. So if you think about it, I'll talk a little bit of leverage now, right? So at the moment, our leverage is around 3, just under 3 that we reported. Naturally, with the kind of cash coming in on this deal, it kind of drops down to pretty much 0 immediately. Now, clearly, we'll do something with the cash. But actually, even with the healthy balance sheet at the moment that we've got, which is kind of further strengthened, we've been doing the majority of that in terms of India investment by internal numbers. So yeah, I'd expect small movements in other lines, excluding one-off transaction costs. But again, as John says, but we've just signed late last night or this morning, right? We've just got to conclude, and when we conclude the transaction, we'll give a better flavour than we're giving today.
And on brand, we will transition the brand away, so they'll move to a new brand. It's India, so there's lots of licenses that and approvals that needs to go through that will take a bit of time. So we've got a commercial agreement between the two parties for that, but eventually a new brand will be established, and Medicover's brand won't be used in India.
Great. Thank you so much.
No problem. Thank you, Christopher.
There are no more phone questions at this time, so I hand the conference back to the speakers for any written questions and closing comments.
I'm looking at the written questions. There don't seem to be many on there. I think in terms of, there's a question about how much will we pay for the transaction from a tax perspective. Look, I've said from a gross to net perspective, in terms of proceeds, we expect total deductions to about 1.5% at the moment, and that clearly would include tax as well as any fees in the transaction. So from the quantum of the transaction, I'd say the team have done a pretty good job in terms of managing that. John, do you want to?
Yeah, so there's another question saying we were saying that India is a real big growth driver for us and we've changed strategy. Why have we done that? It's just pragmatic reasons that, when we look at the deal size that we've got here, we felt, both ourselves and our partners felt that this was attractive enough to look at, and as a consequence of that, it gives us many choices in our existing markets. So it's just a real pragmatic decision on our behalf. That it just makes sense. It gives us lots of opportunities, and it's really good for us. Okay, so I think that's all the questions that we've had. So thank you to everybody. It's an exciting day for us. This is a significant deal for us. We're extremely pleased with it. That's a John in English, extremely pleased. So it's a very positive news indeed. Just the final thing really is to thank all of our colleagues in India who have been fantastic and committed a lot to us over the years. Of course, they're still with us for a period of time as we do closing. So we'll be looking forward to continue to work with them. And a big thank you to all of the teams in many different areas for the work they've put in this deal, which has been quite considerable. So thank you very much, and have a good day, everybody.
Thank you.